Welcome to the Hughes Optioneering Weekly Workshop, where we scientifically engineer trades for greater profit potential. This is the disclaimer slide. You can pause to read it. We're going to move on. Today we're going to look at CAVA, C-A-V-A, or CAVA Group Inc. CAVA is a category-defining Mediterranean fast casual restaurant brand that brings heart, health, and humanity to food. Here's the barchart.com technical opinion rating for CAVA. The bar chart rating is a 100% buy, with a strengthening short-term outlook on maintaining the current direction. Long-term indicators fully support a continuation of the trend. Taking a look at the monthly chart now, note that CAVA just started trading a year ago and it's been doing quite well. Let's see. According to Prime Trade Select rules, a stock is in a bull trend on a monthly basis if the stock price is above the 10-period or 10-month simple moving average. The monthly chart shows that CAVA is well above the moving average line, so the monthly trend in CAVA is up. Next, we're going to look at our daily chart. A stock is in a bull trend on a daily basis if the 50-period or 50-day exponential moving average is above the 100-day exponential moving average. The blue line is the 50-day EMA line, and the green line is the 100-day EMA line. The blue line has been above the green line since January, so the daily trend in CAVA is up. Next, we're going to look at our daily chart that displays the Keltner channel. As a rule, we don't want to buy calls if the stock price is above the upper Keltner channel line. Anywhere inside the Keltner channel or even below the Keltner channel is fine. CAVA is below the upper Keltner channel line, so CAVA is inside the buy zone. Since the trend is up, we want to buy a call. CAVA has plenty of option chains to choose from. We're going to use the July 19 option chain. Right now, the July 19 options have 33 days to expiration. Here's the CAVA option chain for July 19. CAVA closed at 89.93 on Friday. That means any calls on the list from 20 to 85 are in the money. Let's take a look at the profit potential for purchasing the 110 strike call, which is the closest strike to the current price of the stock. The bid-ask spread for the 110 call is 590 to 610. We try to enter at the midpoint, so we'll use 6 even as the buy price. Our call option calculator shows the profit potential for this call based on CAVA price changes and option expiration from flat to a 12.5% increase in price. We can see that if the CAVA stock price is flat at 89.93 at option expiration, the 90 call will lose 100% of its value. Ouch! This is an unacceptable risk. That kind of loss can wipe out our trading account in a hurry. We developed what we call the 1% rule to help us avoid this kind of risk. The 1% rule says to limit the time value portion of the option we buy to 1% of the stock price. That means the stock only has to move up 1% for the call option we purchase to break even and start profiting. Now let's take a look at buying Now let's take a look at buying the 80 strike call to see if it qualifies for the 1% rule. Here is the call option calculator picture for the 80 strike call. According to the 1% rule, we want the call to at least break even if the stock price is up 1%. The calculator picture shows that if the CAVA stock price is up 1%, the 80 call will lose 12.7% of its value. We want that to be break even or better, so the 80 call does not meet our requirements. Let's see if the 65 call will work. The bid-ask spread for the 65 call is 24.40 to 26.70. We tried to enter at the midpoint, so we'll use 25.55 as the buy price. The 65 call works. If the CAVA stock price is up 1%, the 65 call will make a 1.1% or $28 profit. That's better than break even, so the 65 call is the one we'll buy. The call option purchase calculator also shows that if the CAVA stock price increases by 2.5%, the 65 call will make a 6.4% or $163 profit. If the CAVA stock price increases by 5%, the 65 call will make a 15.2% or $388 profit. If the CAVA stock price increases by 7.5%, The 65 call will make a 24% or $612 profit. The 10% and 12.5% numbers are also displayed. You can see that the profits get better and better. And notice that if the CAVA stock price does not make the expected move up and remains flat at expiration, the 65 call would only lose minus 2.4% or minus $62 compared to the minus 100% or minus $600 loss for the 90 strike call that we looked at earlier. Now we want to review a call option debit spread, aka a vertical call spread. For this spread, we want to buy to open the CAVA 75 strike call and buy to open the CAVA July 19 75 strike call and sell to open the CAVA July 19 85 strike call. We're going to base our entry prices on the midpoint between the bid and ask prices. That means we'll buy the 75 call for $16.25 and sell the 85 call for $8.75. $16.25 minus $8.75 equals $7.50. So the entry price or debit cost for the spread is $750. The call option spread analysis calculator picture shows that the spread will make a 33.3% or $250 profit if the CAVA stock price declines by 5%, remains flat, or increases in price when the options expire. Creating the debit spread will allow us to collect an $875 cash credit to our brokerage account for the sale of the 85 call. As we said on the previous slide, this reduces the cost of entering the spread to $750. Here's a note regarding earnings reports. The next CAVA earnings report is scheduled for August 27th. Let's review the trades one more time. The first trade was a call purchase. It said to buy to open the CAVA July 19 85 strike call for $25.55. We also reviewed the spread. The spread said to buy to open the CAVA July 19 expiration 75 strike call and sell to open the CAVA July 19 expiration 85 strike call at a debit of $750. That's it for this week's Optioneering Workshop. Thank you for joining us. We look forward to seeing you again next week.